I have a question for you. How is it possible that the network processing the most volume in history, hitting record stablecoin transfers and powering the biggest prediction market in the world, is currently sitting at an all-time low price? Something is fundamentally broken with the market's perception of Polygon, or we are staring at the single greatest accumulation opportunity of 2025. But there is a catch. We are testing a level right now, 10 cents, that I call the line in the sand. If we lose this, the structure breaks, and we are looking at a 50% drop to 6 cents. But if this holds, the reversal could be violent. Today, I'm putting my own money on the table. I'll show you exactly where I'm buying, where I'm forced to sell, and why this chart setup is arguably the most stressful, yet profitable, trade I'm looking at this week. Let's be real for a second. The price action on Pol has been disgusting. If you have been following this channel, you know I have been in this ecosystem for years. I bought my first bag back in 2021 at 3 cents. I took profits along the way, but watching this recent bleed from the local top of 75 cents in December 2024 has been painful. Right now, we are hovering between 10 and 11 cents. Sentiment is in the gutter. People are angry. They are blaming the migration from Matic to Pol. They are blaming the team. They are blaming the weather. But my job as a trader is not to get emotional. It is to look at the data. And the data is screaming a massive divergence. While the price is dumping, the network activity is absolutely exploding. This matters because usually, price follows usage. Right now, they are moving in opposite directions. That tension is about to snap. So why do I still have conviction here? Let's look at what is actually happening under the hood, because the market is ignoring some massive signals. First, look at the stablecoin volume. In November 2025, Polygon hit a new all-time high of over $7 billion in peer-to-peer stablecoin volume. That is real money moving on-chain, paying fees. This confirms product-market fit. People are using this chain for payments, period. Second, we just had the Madhugiri hard fork on December 9th. This was a massive tech upgrade. It boosted throughput by 33%, bringing us to 1,400 transactions per second. The network froze briefly yesterday, yes, causing delays on Polymarket, but it was resolved quickly. The tech is scaling. Speaking of Polymarket, it is driving transaction counts to a 2-year high. We are seeing adoption that other chains dream of. Yet, the price does not care. Why? Part of it is confusion. I have seen the FUD about the token supply. People seeing unlimited supply on CoinGecko versus the fixed reality. It creates uncertainty. Plus, there is a narrative that the migration to Pol was a mistake, that they killed the brand value of Matic. I tend to agree that the rebrand was unnecessary, but does it justify a 90% drawdown? No. The fundamentals tell me the network is healthier than ever. The usage is there. The tech is shipping. The only thing broken is the price. And that is where the opportunity lives. Now let's get into the charts. This is the weekly time frame, and it paints a very clear, very dangerous picture. We have been trapped in this orange descending channel since that peak in late 2024. Every time we tried to rally, we got stuffed. Look at the moving averages. The 10, 21, and 55 EMAs are all acting as dynamic resistance. We are trending below all of them. That is bearish, plain and simple. However, look at where we are sitting. We are just losing the support of the 1618 Fibonacci extension. We are now wick trading right around 10 and 11 cents. But here is the signal that keeps me interested. Look at the Heikin Ashi RSI below the price action. It is extremely oversold. In fact, it is at a record low since the token migration in September. Every time we have seen these levels in the past, indicating this kind of oversold conditions, we got a bounce. I've added white circles to make it clear. Now we are currently deep in that zone. The rubber band is stretched as far as it can go without snapping. Also, look at the volume profile on the left. The point of control, the price level with the most historical volume, is sitting way up at 24 cents. If we get a reversal, that level acts like a magnet. Price wants to go back to where the volume is. That is a potential 140% move from here just to return to the mean.
Now, let's talk about my strategy. I'm not telling you what to do, but this is exactly how I'm playing this. I have established a load zone between 10 cents and 13 cents. I have been adding here. Why? Because the risk-to-reward ratio is incredible. My stop loss is hard and fast. It is at 10 cents. Specifically, I need to see a weekly candle close below 10 cents to invalidate this setup. If we close below 10 cents on Sunday, I'm out of my short-term positions. I'm not holding a falling knife. If that level breaks, the next major support is down at 6 cents, which coincides with the 2618 Fibonacci extension and the bottom of this channel. If we lose 10 cents, I'll actually flip short and trade it down to that red circle at 6 cents. But if this support holds, which I think it has a good probability of doing given the RSI divergence, my targets are clear. Target 1 is 16 cents. That is the first major resistance. Target 2 is 20 cents, the 618 retracement. Target 3 is 25 cents. Then we have higher targets at 42 and 60 cents, but let's not get ahead of ourselves. I'm using a trailing stop strategy here. If we hit 16 cents, I move my stop loss to my entry price. If we hit 20 cents, I move my stop to 16 cents. I'm locking in profit as we go. I'm not letting a winner turn into a loser in this market. So here's the game plan. We are at a binary moment. The bearish case. The market continues to ignore the fundamentals. The migration fatigue continues, and we close the week below 10 cents. In that scenario, the thesis is broken for the short term. I accept the loss, I cut the trade, and I look to reaccumulate or short down to 6 cents. No ego. The bullish case. This is a massive bear trap. The extreme oversold conditions on the weekly chart kick in. The fundamentals regarding stablecoin volume and usage finally catch a bid, and we reclaim the 11-cent level. In this scenario, the squeeze could be fast. A move back to 16 cents is a 50% gain from here. A move to the point of control at 24 cents is a 2x. For me, I have accumulated a long-term position since 2021, and I added more around 25 cents recently, which honestly, I'm not happy about. But I'm not selling my long-term hold here. However, I'm not adding a single penny more to the long-term bag if we lose 10 cents. This current trade is purely a high-probability swing setup based on the technical extension. To wrap this up, my friends, Polygon is the most used, most hated, and most oversold chain in crypto right now. The data shows growth, the price shows death. Usually, the data wins in the end, but the market can remain irrational longer than you can remain solvent, so respect that stop loss. I wrote a detailed breakdown of this setup for my community on Telegram this morning, covering exactly how I'm managing the hedge if we do break down. If you want those updates in real time, instead of waiting for the YouTube video, the link is in the pinned comment. It is free. I also covered the graph recently, which is showing a very similar accumulation pattern. If you want to see another high potential setup, check out that video right here. Much love for watching till the end. My videos are never financial advice, and I will see you soon in the next one.